Liquidity refers to the ease and speed with which assets can be turned into cash. The more easily an asset can be sold, the more liquid the business is. Liquidity ratios are concerned with the short-term financial health of the business. It is imperative that a business is able to meet its short-term debts. This, in effect, means that a business should be able to have sufficient liquid resources to pay its immediate bills. If the business is unable to do so, then it could lead to the business failing. There are two ratios that could be used to measure liquidity. These are the current ratio and the acid test ratio. The formula for the current ratio is current assets divided by current liabilities, and you'll find the necessary information for the current ratio on the balance sheet, also known as the statement of financial position. The current ratio is also known as working capital ratio. Current assets show the cash or near cash available to the business that can be changed into cash within 12 months. They are liquid assets. Examples of current assets include trade and other receivables, or also known as debtors, and that relates to the money that is owed to the business by customers. Cash could be cash in a bank or cash on the premises. That's also an example of a current asset. And stock or inventories. So this is unsold stock or raw materials or components and finished goods that the business has available. Current liabilities are short-term debts that need to be paid off within a year. Businesses want current assets to be more than current liabilities. Examples of current liabilities are an overdraft that the business might have, and also suppliers that they need to pay, also known as creditors. So the formula for current ratio is current assets divided by current liabilities. A ratio of 1.5 to 2 to 1 is generally considered to be ideal. The range will depend on the type of business and the industry it's in. Current ratio is expressed as a ratio, but not as a percentage. If the ratio is higher than 2 to 1, it could mean that the firm is inefficient and has too much money tied up in stock, or they're not chasing up their debtors for payments. It could also mean that they have too much cash in the bank, which could be used for other purposes within the business. On the other hand, a lower ratio value of 1 to 1 would mean that it may not be able to meet its debts quickly and could indicate that there are liquidity issues. Now we're going to work through a number of calculations, so grab a pen and a piece of paper and let's get started. A two-part question. We're required to calculate the firm's current assets and calculate the current ratio. So if we look at the figures here in the table, we can see that the current assets here are cash, £15,000, and inventory, also known as stock, £27,000, and the trade receivables, £3,000. So if we add that all up, the answer is £45,000. So we have £45,000 worth of current assets. Now we're required to calculate the current ratio. So we know that the current assets are £45,000, and we put that information into the formula alongside the current liabilities, which are £26,000. And we have an answer of 1.73, or it could be 1.73 to 1. And that means for every £1 of current liabilities, the business has £1.73 of current assets available. Next question. And we're required to calculate the current ratio again, and the data is in the table. So the current assets here are £80,000 and the current liabilities are £48,000. So we input that information into the formula. And that gives us an answer of 1.66, or 1.66 to 1. Now on to the acid test ratio. So the formula for the acid test ratio is a little bit different from the current ratio, and the difference is that we deduct the stock. So it's current assets minus stock divided by current liabilities. The acid test ratio is also known as the liquid capital ratio. This ratio is more stringent than the current ratio as it excludes stock. Stock is deducted because a business may not be able to convert it into cash quickly. This ratio is also expressed as a ratio. The acid test ratio will be lower as the stock is deducted. Ideally, if the ratio is 1, it would mean that the value of the current assets are equal to the value of the current liabilities. So if it's 1 or 1 to 1, then that is ideal. And it means that there is enough cash to cover the overdraft and to pay our suppliers. A very high figure for liquidity ratios indicates that the business has too many current assets, and it might be better off investing more in fixed assets to help generate more profit in the future. For the acid test ratio, if the figure is below 1, this means that the firm has less cash and receivables than its current liabilities, which means that the firm may experience liquidity issues and struggle to pay its short-term debts. This means that they may leave themselves vulnerable to not being able to pay their creditors on time, their suppliers, which means they may be subject to fines, delays in getting products, and it might also create a bad relationship with them. Let's calculate some more ratios. Onto an acid test ratio question. Using the data in extract B, calculate the difference in Morrison's acid test ratio between 2014 and 2015. You are advised to show your work in. Now we have a snippet of information from the annual report, and we need to calculate the difference in the acid test ratio. So that means we need to calculate the acid test ratio for 2014 and then calculate it for 2015 and then work out the difference. This question is a little bit tricky, but let's work through it. First thing that you do is put the formula down. Current assets minus stock or inventories divided by current liabilities. It's good to put the formula down because it gives you some guidance, and also you can be credited for it as well, just in case your final answer is incorrect. So let's work on 2014 first. We know from the data that this is calculated in millions. However, we will abbreviate where necessary. So 2014 is where we will start. We need the current assets for 2014, which is 1,429. And we need to deduct the stock, which for 2014 is 852. Divide that then by the current liabilities, which is 2,873. That equals 0.20 to 1. So that's 2014. Let's do the same for 2015. Current assets for 2015, 1,138. Minus the stock. You must remember to deduct the stock. That's 658. Divided by the current liabilities, which is 2,273. And that equals 0.21 to 1. Now we can't just stop there because within the question it asks us to calculate the difference between 2014 and 2015. So we've done quite a lot. We've calculated 2014 and 2015. So now give it a go and see if you can calculate the difference. So 0.21 minus 0.20, and that equates to 0.01. That is our answer. Thank you for watching this video. The next two videos that will appear on the screen are what YouTube thinks you should watch next.